This is PolarisLive. I'm your host, Sarwar Kashmiri, welcoming our viewers from around the world to this special edition of PolarisLive. We begin our second year today, and I want to welcome all our viewers. Many of you have supported us for so long. Greatly appreciate that. As you know, this program is brought to you in conjunction with the Foreign Policy Association in New York. China has launched a 5-year plan to control its economy, especially by regulating the fast-growing e-commerce financial technology companies. Just the last week, the acquisition of Soho China, one of China's most successful real estate developers, by the Wall Street giant property investor Blackstone, was called off because Chinese authorities would not approve it. 2 weeks before, China abruptly announced that private school tuition companies could only operate as nonprofits, virtually wiping out a billion-dollar industry. In most cases, Chinese regulators strike without much warning, sometimes over the weekend. Might this be the end of the capitalist streak in China that in a mere 4 decades has transformed China into the second largest economy in the world? What does it mean for the investors in China, the US, and around the world? To help explain all this to us, to explain all this to us, we have with us today Mr. Shan Weijian, who's chairman and CEO of PAG, a Hong Kong private equity firm, one of Asia's most influential investors. Over more than 20 years in investing, he's led a number of landmark transactions across Asia. He holds an MA and a PhD from the University of California in Berkeley and an MBA from the University of San Francisco. Shan is the best-selling author of 2 books, Out of the Gobi, My Story of China and America, that has a foreword by Janet Yellen, now U.S. Treasury Secretary, who called it a powerful memoir and commentary that will be one of the most important books on China of our time. One with the potential to reshape how Americans view China and how Chinese view life in America. So please welcome Mr. Shan Weijian. Good morning, Shan Weijian. How are you, and what is Hong Kong tonight? Is it warm, cold, snowing?
Well, Hong Kong is always warm. Today is probably about 90 degrees.
Oh my.
Good evening, good morning your time. Thank you
It's-
very much for inviting me to this forum.
No, I explained earlier to our viewers we had some technical issues, but I'm so happy you're on. And, Shan, I wanted to ask you, when we last spoke a couple of months ago, you told me that Americans simply don't understand how capitalist China is.
I did.
Is all this coming to an end with what we're seeing now?
Well, I think that China has really followed a path of unbridled capitalism for a long period of time. You know, in the past 40 years, we know that China has grown tremendously. And the way that China did it, getting itself out of poverty, which was 40 years ago, to representing about 3/4 of the American economic size. And China did so by embracing the market economy,
Right.
abandoning the centrally planned economy, embracing the market economy, or simply put, capitalism. And for a very long time, the Chinese regulation has been lacking in many different sectors. And that's what I call unbridled capitalism.
Okay.
And I think in many ways, the Chinese style capitalism was more unbridled, and maybe remains so today, than even the United States. certain regulations have not been in place. But I think we're seeing a shift towards more regulation in the marketplace. And sometimes new regulations are initiated or put into place without much of a process, without much of a warning. As you described,
Right.
things may happen suddenly, which have a tendency of shocking the market and spooking investors. And that's what we see today.
How, if I may ask you, is this coming from nowhere? You're one of the most sophisticated people in this Asian investment business. Did you see any of this coming around the corner?
Oh, yes, of course. I don't think that the objectives of recent policy actions, when I say recent, I mean in the past half year or past several months, I don't think the objectives are to suppress the private sector or to stifle economic growth. The leadership would be out of its mind if the objectives were to stifle its own economic growth,
Right.
which I don't think is the case. But I think that the Chinese leadership, the Chinese government is very much concerned about systemic risks. You see, China has grown in the past 40 some years without the economic recession. I just mentioned that China developed by embracing a market economy. In any market economy, anywhere in the world, anytime in history, there are economic cycles. There are recessions, but China has not experienced a recession in the past 40 some years. How has it been able to do so? We'll never say never. It may happen in the future, but so far it has not happened. I think China, because its system is different from what we are familiar in the West, has a way of managing certain systemic risks to prevent, for example, the housing crisis that happened in America in 2008 and 2009, which led to global financial crisis. And the Chinese leadership has a tendency of trying to cut such risks, reduce such risks long before they became a real threat to the system. So let me just give you an example. 5-6 years ago, shadow banking system was a major issue as observed not only by domestic participants in the markets, but also by foreign observers. Societal debt was rising so fast that people thought that eventually it was going to be a systemic risk. And there are many articles written about China's shadow banking system. And China began to crack down on shadow banking system since about 5 years ago.
Right.
Today, shadow banking is reduced to a shadow of its former self. There used to be tens of thousands of P2P lenders, peer-to-peer lenders. Today, almost none of them exists. And the real estate sector is another one which was growing very rapidly. Real estate prices were rising, but real estate companies expanded by leveraging, by borrowing a lot of money. So more recently, the government imposed limits on to what extent real estate companies can borrow from banks or from the market. Basically, your debt to total asset ratio cannot be more than 70%. Debt to equity ratio, not more than 100%. It has to be less than 100%. Cash to short-term loan coverage ratio has to be more than 100%. So they have taken a number of measures to reduce what they consider to be systemic risk. And therefore, when Ant Financial was pulled, as you remember, from IPO towards the end of last year, I was not surprised because new regulation on consumer finance industry was in the coming. The interest rate ceiling was lowered, capital requirements were increased, and therefore, I think it was quite prudent to pull the IPO for Ant Financial until it complies with the new regulation.
So,
So
Sean, let me sorry to interrupt, but I've been talking to some of the investors and heads of some companies on Wall Street lately, and one of the things that really confuses and perplexes them is this last episode where Blackstone, which was going to buy Soho China, one of the best known companies here. All of a sudden, the authorities in China did not give them permission or to buy it. Now, here's the CEO of Blackstone, Mr. Schwartzman, who's really established himself with China, has been putting a lot of money into China, has courted Chinese leaders, and all of a sudden, out of nowhere, seemingly to us here, boom, it just disappears without any kind of forewarning. So I guess what I'm asking is, as you know, we have these issues where America has tariffs on China and so on. But the financial industry, Wall Street and elsewhere in America, has never wavered from investing money in China. It's very bullish on China, in opposition, some would say, to what's happening in the rest of the industry with the tariffs and so on. So I guess what I'm asking is, and this is a question people pose to me, is what are we to make of it? Was this a one-off? Can we really continue thinking of China as this huge market waiting to be tapped by American financial firms? I mean, do you understand what I'm saying? And I just thought you would shed some light on this.
Sarah, actually, I know Soho China pretty well. The controlling shareholders, Pan Shiyi and Zhang Xin, the couple, are good friends. And I know Blackstone very well as well. It's public information. Blackstone is also a shareholder of PAG, my firm. I don't think that the authorities rejected the acquisition of the shares by Blackstone of Soho China. That's not, at least, what was publicly disclosed by both the company and Blackstone. It was still going through the regulatory approval process. It has not reached the point for the regulators to say either yes or no. The fact is that regulators at this moment do not favor real estate companies, and that's a fact. In fact, we, PAG, 20 days ago, just invested $2.8 billion US dollars into one property management company in China in one deal, $2.8 billion. And this company is also seeking public listing in Hong Kong and is going through the approval process. And for real estate related companies, the approval process has become much longer because this is not a favored sector. And the Chinese government is very much concerned about housing affordability, about leverage getting out of hand. And that's why real estate is really, in the crosshairs of government regulation. So I think that Blackstone is discouraged by the macroeconomic conditions to call off the deal. And this is the second time. The first time they offered 6 Hong Kong dollars per share. And then the market was not going in that direction, so they canceled that deal not long ago, a few months ago. And then it came back with $5 per share. And now both parties announced that they will not continue with the transaction because they were not making progress with regulatory approvals, even though the drop dead date is by the end of this year. So I don't think that the regulators have rejected it. Neither has the regulator approved it. So I think it's by mutual consent that both parties decided to part company.
I find that so interesting. And of course, how fortunate it is that you know both parties, which why am I surprised? I mean, you're one of the big, influential players in Asia. But Shan, this raises a very interesting question because like most people, a lot of us who try to keep abreast of these issues get their information from a couple of papers, New York Times, the Wall Street Journal, of course, the Financial Times. And unless I'm mistaken, the portrayal in the media was quite different from the way that it really seems to have happened. For example, the Wall Street Journal reported that, well, because they didn't receive the permission in time from the regulators, they just called it off. You've added a lot more depth to it. So I guess where I'm going with this is, are you finding that financial journalists are really not doing as much of their homework as they should? And by that, I mean Western financial analysts. And also, do you think that some of the paranoia of China is flowing into reporting in the financial and what do you think? Do you have any thoughts on that?
Yes, although that's not supposed to be the subject that we're talking about today, but I can make some remarks in that regard. It seems to me
I would just be curious because a lot of investors, not the big investors, get their information from these papers.
My observation is that Western media, when it comes to China, tends to cherry pick negative stories to report. So if you look at each of the stories, they may be factually correct to a large extent because they fact check, they make sure that they report the truth. But if you cherry pick all the negative stories, holistically, you don't present a full picture. And that's what I see. So to some extent, the media has become a giant echo chamber by itself. It just repeats what they like to report.
Well, listen, that was not going to be the topic, but I just wanted to bring that in because it kind of ties in on the margins. But here's another one, right? I mean, a couple of weeks ago, all of a sudden, it seems again to observers on this side of the world, all of a sudden, the Chinese authorities said that these companies that offer private tuition to school students to make them do better in school, that they were not going to allow to be for-profit companies anymore. And over the weekend, this industry, which had become a multi-billion-dollar industry, which listings in different places, excuse me, virtually disappeared. So it's this kind of out of the blue action that is surprising a lot of people here. So can you talk about this industry at all? I have a feeling that there's more to it than just saying you can't be for profit. What do you think, Shan?
Again, going back to what I said about the concern about systemic risks and social issues, I think each of the policies, if you look at the objective of the government, you would find that the concern is related to social issues. And in this particular regard, there has been a lot of talk about the burden for parents and children or pupils to have to study after school for in-school materials. That is after-school tutoring of in-school curriculum. So the government's policy is designed to reduce the burden for parents. They consider this to be related to income equality issue because some people are better able to afford after-school tutoring than others. They also think that this after-school tutoring imposes too much of a burden on children. In this regard, I happen to agree with them. I pulled my own children out of after-school tutoring classes when they were small. The problem with the Chinese policymakers is that they very often don't consider consequences of their actions. That is, unintended consequences of their actions, nor do they provide any guidance to the market when they decide to take some policy initiatives. So there's not much of a process to go through. And therefore, as you said, they may issue an edict overnight on a weekend, and all of a sudden that shocks the market and spooks all the investors. And that's the problem. But I don't think the purpose is just to kill a particular sector. The purpose, as I explained, is more social related. But unfortunately, the execution is extremely poor, and the unintended consequence is actually very severe.
That's so fascinating what you have just said, and I'm going to connect a couple of dots which probably can't be connected, but let me try. I'm thinking now about the massive infrastructure plan that China put into place, the Belt and Road Initiative. I'm thinking about all of the different ways in which China eliminated basic raw poverty in China, showed great leadership in looking ahead to connect itself with different parts of the world. So what you're telling me is that this may be another way that China is showing some vision and leadership, because the issue, as you've outlined it, about children facing the pressure, and there are other reasons beyond just the money reasons why the government wanted to do this. These are issues that are also surfacing in America. People are worried about them. So am I right in saying that this is just one other way that China is looking forward and perhaps showing some leadership that we've not fully absorbed and processed yet in the West?
I wouldn't call it leadership. Just now I referred to how China's capitalism is unbridled. So there has not been enough regulation in China, and China very much is playing the catch up. If you look at regulation, I would say that the EU is probably at the forefront of regulations, whether it comes to environmental protection or big tech companies. The EU is very often ahead of the United States, with the United States not far behind. And China, I think, is very far behind in terms of various regulations. And whatever happening in Europe, in the United States, you would expect to happen in China sooner or later. I know so far it has been later. Again, I think the problem with China is that when something happens, it happens very quickly. Microsoft may be subject to antitrust litigation for years and years before it received the verdict, right? And in China, it could happen within a week. So that is where I think the market very often is surprised. And I think that there should have been more coordination among different departments of the Chinese government so that they prepare the market and they're more mindful of the interests of investors, especially foreign investors like ourselves. We don't like to be surprised, but we're sometimes surprised, even though we're on the ground, we understand the market. So we, by and large, have avoided the problems that many of the foreign investors find themselves in recently. For example, we used to be an investor in the largest consumer finance business in China about 3 years ago. But we detected the regulatory wind was changing, the interest rate ceiling was being lowered, capital requirements were being proposed. So I proposed to the controlling shareholder, and this company is foreign owned by foreign investors, foreign controlled. I proposed to the controlling shareholder that we extend our put right for another year to see what happens with regard to regulation. He wouldn't agree to it, so we exercised our put right and got out with our 15% IRR. Now, at the time, we thought the IRR was low because we typically would generate much better return than that. But in retrospect, this was 3 years ago, we timed it right because the regulations, one after another, came for the consumer finance industry. So on the ground, we very often could feel the change of the wind. But I hope that the government will be more transparent when it considers new regulations.
So are you telling me, as we start running into the end of our program, Shan, are you telling me then that this is not a time for Americans as a whole to say, my goodness, what's happening in China? It's changing before our eyes. What does this mean for growth, American exports, and so on? That they need to sit back and absorb and think a little more and talk to people like you, understand what's happening on the ground a little better, that this sense of panic is too strong, but this sense of concern that is being expressed is a little bit not correct. What would you tell people on Wall Street?
Well, I think it's good to be concerned. As an investor, you would always want to look at the risk first, before you even think about the upside. And, you have to be familiar with the market. But I would say that you were talking about connecting the dots and looking for the pattern. And there are a few areas that we have to be very mindful of. When it comes to consumer rights, when it comes to data privacy, it comes to choices for consumers, affordability of housing, healthcare, and education, you would expect the regulators to come out with new policies to enhance the protection of consumers, to address the inequality issue. The inequality issue in China is now worse than in the United States. If you just look at Gini coefficient, what is better in China than in the United States is the poverty issue. The bottom 50% in China is doing much better in the past 20 years than in the United States. That's one category, that is consumer rights. The second category would be about fair competition. This antitrust measures against Alibaba and some others, including some companies that we have invested in. Unfortunately, we got out in time. Those are very much in trend with the European countries and in the United States. Environmental protection is where you will see a lot of action. Some inefficient producers will be at the risk of being shut down or consolidated by more efficient producers. So you have to be mindful of all these different areas which may see new policies, which may affect investors. And as long as, in fact, in the investment world, everybody is very focused on ESG, which, as you know, environmental protection, social responsibility, and governance are big issues for private equity investors. If you keep those things in mind, typically you would avoid the problems that many investors face. For example, we don't invest in gaming because we don't think that's socially a good thing to do. We don't invest in e-cigarettes because we don't think that's socially a good thing to do. We don't invest in companies which pollute. Again, that's a social responsibility, environmental protection issue. If you're mindful of ESG, look at all these things, all these policy initiatives that have recently happened. If you're mindful of ESG, you pretty much can avoid getting into trouble in China. And that, I think, is very important, not only in China, but also in other countries.
Well, Shan Weijian, you've really thrown a lot more light on this whole issue, and I'm so very happy that we were able to connect with you one more time. So I want to thank you very much for appearing here today. So thank you.
It's a pleasure. Again, I apologize for a technical issue at the very beginning.
Not at all. If you just stand by, I'll come back to you in a moment.